Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right. Paul Winkler, Investor Coaching Show, along with Mr. Jim Wood hanging out here with me today. Okay, so, we on Channel 5, I actually started talking a little bit about this. I was on there a little while back, and we just kind of stuck a couple of my books together because there are a lot of things I've been doing on there. Confident Investing, I put on my website along with the Retirement Income Guide. You go to paulwinkler.com/books, and I just lumped those two books together. $19, pretty cheap to go and grab a couple of books that are going to, I personally think, change your life. So you can check that out there. But my book isn't the only one out there about investing, right? You know, there's some stuff out there that gets a lot more airplay and a lot more media hype than my book. But, that's what this segment is going to be about. They were talking about a new book that is out there right now and was being talked about on CNBC. And it was this one, Jim Cramer. Just check this out right here. But
I want to talk about why you're here today.
Sure.
I don't want them to roll past this. His new book is out tomorrow.
Sure.
It's called How to Make Money in Any Market. Make sure you go get this book. This is for
so nice.
anybody who wants to figure out what they should be doing. And Jim, this is a different book for you.
Yes, well, it's a how-to book, tough category. But no, let's say someone mentions a stock here, okay? And a person at home says, you know what, I want to know how to research that. I want to know if it's right. That's the process. I talk about how you observe your curiosity. Here's how you can look into it. Some of it is the fact that we now have ChatGPT and Perplexity. But a lot of it is just like, please invest right. And you can invest in individual stocks.
Listen close to this,
plus
Jim.
index funds, which is now somehow against the orthodoxy.
He said you can invest in individual stocks. Plus, let me just replay the last part again.
Invest in individual stocks plus index funds, which is now somehow against the orthodoxy.
Now, number one, what were indexes invented for, Jim? Do you want to take that for $250?
Well, I think they were invented to capture the returns of market segments as opposed to investing in individual stocks.
That is exactly right, because the idea was that investing in individual companies, the managers were simply not getting it done. I don't care how smart you were. They weren't getting higher returns than when the market was on its own. So number one, he's saying you can't do both. And it's like, it doesn't make any sense. There's no logic to that idea, putting these two things together.
But it's never stopped him.
No, it has never stopped. So he's talking about individual stocks, right? Now, number one, check out, just check this out. When it comes to individual stocks, how good of a guide would Jim Cramer be regarding investing in individual stocks? I mean, we got to listen what his track record is like when it comes to giving advice about investing in individual companies.
The original point, there's a lot at stake for his companies, given how often they touch the federal government.
Look, I think that his technology is superior in every way to Waymo. My money's on Waymo now.
What?
Waymo's the one that's going to go. But this is like a horse race. This thing came up lame. But Waymo's going away.
You have been day in, day out backing Musk's technology over Waymo.
That's because of the fundamentals.
Over?
That's because of the fundamentals. I mean, the fundamentals. That was pre-Epstein.
I guess we just have to wait and see what's next. Who comes back and says something?
Someone's going to get to ask him in Austin next week. Yeah, about all of it.
Okay, so what does he do? He flip-flops regarding Waymo, number one. And he's like, yeah, we ought to invest in this. No, we shouldn't invest in this. No, that's a good idea. Yeah, we ought to do this. And you go, well, which one? I guess it depends on which day you happen to be listening, right, Jim?
Yeah, well, he's been destroyed publicly so many times over different past calls, including, one we play constantly is I don't care about what your, money for the next couple of years, take it out of the market for the next 5 years or whatever, right towards the end of the Great Recession. I mean, it was a horrible call. He's done, other calls. He just got destroyed one night by Jon Stewart, just out of the blue, because of calls he had made in terms of propping up some companies that immediately got crushed and went to nothing again during the Great Recession. And so his track record, again, is not anything to jump up and down about, but hey, that can't stop him from writing a book telling you exactly how to be him.
Yeah, exactly. And, just give you more. It's not just that. Check this out.
Meanwhile, Jim, Tesla's going to go for 4 days higher today. It's up 17% since Friday.
We got a lot of downgrades, and it visibly stuck. It didn't go down, and then it went up 10%. I'll give you a good example. Guggenheim has a sell on it today. If I crossed out the word sell and I read it, I would be buying. I mean, it's that positive. It's about robotaxi, and it's about the total addressable market. And initially, Tesla won't do that well. But I've got to tell you, I would never sell Tesla.
Never.
And then Piper Sandler with just a few bullet points about why it's going to be fantastic. Driverless Teslas have been spotted in Austin. Of course, he's walked back when it's going to be. But I continue to believe that you've got to own the stock.
Yeah.
But the fact is, David, stock's bottom. And now you're talking about, take a look.
It was just last week after the posts, you were saying, I don't think you can own it.
270. It's at 3. I took 60 points.
Okay, all right.
Just last week, I don't think you can own it. I would never sell it. And then he goes and calls him on it and says, you just said last week I wouldn't own it.
What do you want from me?
I want answers is what I want. I want the truth.
You can't handle the truth.
Ooh, yeah, exactly. Exactly. You listen to that and go, what? Wait, what? What did he just say? I wouldn't own it. I don't want it. You don't want this thing. This is, is it just this? Oh, I don't know. Maybe you decide. Listen to this.
If you're a young person and you're thinking about crypto, I think it's smart. I think crypto should be part of a person's diversified portfolio. I can't tell you not to own crypto. I own crypto. I own Ethereum.
Oh, so he says that's part of your diversified, it's part of a balanced breakfast. Have a little bit of crypto with your stocks. Wait a minute. Or does he believe that?
But I would not touch crypto in a million years because I wouldn't trust the deposit bank.
And you're making no distinction between centralized, decentralized.
They fought regulation. They didn't want regulation, and you don't have regulation. So if you have your money in any of those, look, I'm not calling you an idiot. I'm just saying you're using a lot of blind faith.
So does it remind me? It's just like the old sales thing, Jim, that they used to do. They would send, let's say, 1,000 letters out. And they would send 50% of those letters, 500 of them would say, you need to buy XYZ stock. And 500 letters, 50% of them would say, you need to sell XYZ stock. And then what they would do is if XYZ stock went up, they would follow up the first set of letters that were sent, the first 500. And they would send a follow-up letter. We told you to buy XYZ stock, and see what happened? It went up. Then what they would do is they would send out another thing of those 500 people. And they say, ABC stock, you need to buy it. And they'd send 250 letters to people saying you need to buy it. 250, you need to sell it. And then if it went down, they would send a follow-up letter to the ones they sent and told it would go down. We've been right twice. Look, we told you to buy this stock. We told you to sell this one. Now, if you want our next prediction, you're going to have to pay for it. And that was literally what they would do.
That was the whole business model of sports betting, newsletters and picking services and stuff like that. That was exactly it. I had a relative that used to get taken in all the time by that. He'd call them up, they'd give them one, and like, oh yeah, it worked great. Oh, the next one, okay, that one worked great. Oh yeah, sorry, we got our big super, all out wonderful pick this week, but you got to pay for that one because it's a good stuff.
Yeah. I mean, it is a game. Mutual fund companies would do this. They would set up several mutual funds and they would seed them with money. And the ones that would do better Then the other ones, they might have 5 mutual funds. They would seed money. The mutual fund company would put a little bit of money in 5 different funds. And whichever manager had the best performance, that was the fund that went live. And they would actually market, and they were able to use the past performance on the fund with the public.
Yeah, what's the number now in the mispresentation in terms of dead funds? It's got to be like 45,000 in terms of
it's a lot.
Funds that have been killed off since the advent of mutual funds.
Right.
It's insane.
And what Jim is talking about is something called survivorship bias. And it's literally the funds that you see out there, that you hear marketed and you hear talked about, are the ones that didn't get shut down. They would shut down the funds that had bad performance just to make their average fund return look better. I mean, if you had any, and this is all stuff that I talk about in the book, Confident Investing. That's online, paulwinkler.com. You can go to paulwinkler.com/books, and you can order both that and the retirement income guide there. It's just a great way just to get your head wrapped around investing and learn a little bit more, because the more you understand this stuff, the less you get taken advantage of. So, and I don't talk about those books enough. I started that. The original writing of Confident Investing was literally in 2007, which is interesting because it was just before this major market crash. And the beauty of it is I haven't had to rewrite any of what I wrote as far as principles of investing. All I've done is updated the book with new data over the years. I haven't had to do anything because the principles stand the test of time. It's really what it gets down to. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities and interest-bearing accounts and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, we're back here on the Investor Coaching Show. Paul Winkler, along with Jim Wood. PaulWinkler.com is the website that you can check out there, and all kinds of videos on Social Security, on Medicare, on just about anything you want to learn about. You can go out there and check it out. The other thing, there was a little segment. This is a commercial, and I get a kick out of how investments are marketed so often. I'm going to let you just respond to this one, Jim. Just check this one out right here. This is a commercial on a savings account this guy is talking about.
Rather than get rich quick, I believe in get rich slow. The high yield cash account at Public actually had higher rates than anything else I was able to find online. I don't want to be losing sleep over having made risky investments. I needed something stable that could really give me long-term financial benefits. I know my money's working hard for me, and I know I can access it anytime I need it.
Okay. Rather than get rich quick, he wants to get rich quick. Get rich slow, excuse me. Go ahead, run with that.
Well, I just say, okay, does he plan on living 150 years? It's back to fear.
Does he plan on living 25 years? This guy looked like he was in his 50s.
Oh, really?
Does he plan on living 30 years? And you look at an investment, an asset class that has an expected return of no more than 1%, maybe, above inflation.
Right, and that's it's back to, again, it's hitting all the fear buttons, right? I don't want to lose sleep. I don't want this or that. Well, what's the money for? They don't talk about, okay, this is money I'm going to spend in 10 years, money I'm going to spend tomorrow. None of that. It's just let's scare people so they'll look and see, this high yield thing and know it's never going to go down. Well, you can go broke slowly if you're losing ground to inflation and taxes on that interest.
Exactly. You look at the historical return of fixed income investments like that, it's 0.4% above inflation. Well, that's before you consider taxes. If you consider taxes, it's negative. I mean, you're literally looking at putting yourself in a precarious position.
So if that's to buy your lake house, next year, then that's a great place for it.
That's exactly right.
But if it's for a multi-decade retirement, not so much.
And that's what he's talking about. He's talking about for the long run, getting rich slowly. I mean, I don't think getting
really
rich is in that equation at all. The other thing I thought was interesting this week was a little bit of talk about the fourth industrial revolution. And, the idea behind AI, what its position is going to be, and how it's impacting things right now. Because interesting data came out this week, and I'll talk about it in just a second. Just check this out.
Greg Ip's got a great piece in the Journal today looking at why GDP and employment are separating so dramatically. They don't always go together, but it's rare they're this far apart.
Well, I just think that this is very different. This is the fourth industrial revolution that Jensen Huang keeps talking about, which he says at the beginning, you'll have people who are let go, but individuals have basically an assistant, and the assistant improves their productivity. So in the end, you will need more workers, because if you can improve productivity, then each worker is worth even more. I would say an outfit that's hurting would say, no, we're not going to do that. If each person is doing even more, we can lay off more people. So I think right now we're in the layoff stage.
Yeah, so it is interesting in that we're talking about this as another industrial revolution. I've talked about this before, where it was people at work that got replaced, machines as time went on. In the beginning, you might have layoffs. Now, they're talking about the very beginning that unemployment and GDP were both going up, which is very unusual, and that's true. Normally, when you have GDP, gross domestic product, that is the growth of output in a country, for a country, if that is going up, it is normally because people are employed and they're buying stuff, they're getting out there and they're purchasing and they're driving the economy. If unemployment is what's happening, where you're starting to have some unemployment where less people are working, they can't buy stuff, so GDP typically goes down. But the reason for it in this particular instance, where they're both going the same direction, is because people are becoming more productive. Now, what happens when they become more productive is they end up actually, you'll need, as people acclimate to the new world as it is, where all of a sudden now they start to learn how to use AI. They use it to be more productive. That's what I think is really critical. And that's why I'm always telling, younger people when I'm speaking to groups, go get out there, get used to this stuff, become very fluent in this, because the person that knows how to use this as a tool will be the person that's more employable in the future.
That's funny. That's exactly parroting something that I read from a guy named, I think it's Peter Diamandis or something, who's always kind of a very futuristic, kind of forward-thinking guy and everything. That was his exact message. Don't be afraid of it replacing you. Learn to use it. Right.
Yeah, I was in a meeting yesterday, and I was showing the person running the meeting. I says, "Let me show you what I'm doing. I'm recording you as we're talking." This wasn't a business meeting for finance. This was in another area, and I was just attending this workshop, and I showed her what this thing was doing. I showed her the bullet points of everything she had said for the last 2 hours were in beautiful, neat bullet points, and she looked at it and she was, "That is so cool." And I said, yeah, it is. It really is, because I hate taking notes because it takes me away from concentrating on what you're saying. Now, I'll take a couple notes because it does engage me, very little. But this thing is taking notes for me that I can go back and look at and review and remember what it is you said. But I get disengaged when I'm sitting there writing because you're on to another point. And I'm still writing the last thing that you said. And she said, wow, that is so cool. But, that and being able to get access to information quickly and ask questions and get those questions answered, I think it's beautiful.
And with me, just the fact that I don't have to try to read my own handwriting 6 months later is a big plus.
I think that's not a bad thing. Now, one of the things that was being talked about by the president of the Fed in Chicago is talking about the risk of AI overbuild. And I thought that was interesting as well.
If you look at data centers, they're booming. We should think about what happens if the growth rate of AI is not as large as its biggest proponents think. Might we get over our skis a bit with overinvestment? and have to clean up if there were a bubble, I think we do want to think about that topic.
Chicago Fed President Goolsbee was squawked this morning, his perspective on AI, and to your earlier point, Jim, on just how much is riding on this all working out.
Well, I think a lot is. I think that, by the way, there's big competition. We didn't talk about China. China's 1-for-1 with us so far. Some people say they're ahead of us. I think it's firm buying because if it's a fourth industrial revolution, then...
And that's it. That's just, the thing about AI is that you can watch out. You better watch out. If you start investing in it and all of a sudden it isn't as big as they think it's going to be, because the hopes of the future are super, super hot. If it doesn't happen, you can get really burned. So really watch out. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.